For those of you that don't know me, I'm Jerry Murphy. I'm partner in charge of our manufacturing distribution services team. Again, welcome everyone to our webinar with our special guest, Susan Tamillo. Before I introduce Susan, I want to take care of a few housekeeping items. Please submit your questions using the question feature in the GoToWebinar. We have some dedicated time at the end of the presentation to address many of your questions, and we're happy to connect you with Susan directly to answer any other questions we don't get to during the Q&A session at the end of Susan's presentation. You'll notice there is a PDF copy of the slides available in the handout section on the GoToWebinar. And if you like CPE credit for today, we'll be offering that. Make sure to take all 3 of the polling questions so that we can give you the CPE. We'll have a polling question at the beginning, middle, and end so that you can get that CPE. The certificates will be circulated to those who want the CPE about 3 to 4 weeks from now. Susan, can you move it to the next slide, please?
Yes.
For anyone that's not familiar with Sikich, we're a leading professional services firm specializing in advisory, technology, accounting, and tax services. We have more than 1,500 personnel providing services and solutions to a wide range of industries and pride ourselves on positive collaborative culture with our clients. Manufacturing distribution is one of our largest verticals that we serve. Susan, you go to the next slide. I'll point out here is a slide that represents a broad spectrum of the services that we offer to our clients to help improve their performance and long-term goals. And without further ado, I'd like to welcome our guest speaker, Susan Tamillo. Susan's a managing director of our investment bank here at Sikich, with over 15 years of experience in strategy, management, consulting, serving industries including manufacturing distribution. Prior to joining Sikich, Susan was a director at a boutique investment firm where she focused on mergers and acquisitions for privately held companies. Susan, thank you for joining us this morning. I'm really looking forward to your presentation. I've got a sneak peek of some of your slides. I'm really anxious to learn more about what you have to say. And with that, I'll let you go ahead and take control of the presentation. Thank you.
Thanks, Jerry, for the introduction. I appreciate it. And it's nice to have my picture off the screen, but I guess you guys can all still see me live. So today we created this agenda based on input from people that we had in a survey, but as Jerry mentioned, we're welcoming your questions throughout the presentation. We want to make sure that the content is meeting your needs. What we're going to do is start out with M&A volumes and EBITDA multiple trends over a relatively long period, just to give you historical context of how the deals move across different economic cycles. Then we'll talk about conditions, both economic, recessionary, and ones that are maybe perhaps more in your control that would impact M&A volumes and multiples. And then we'll switch into topics around how deals typically get financed, what we're seeing in terms of buyers that are still active in the market and looking for opportunities. And then again, at the request of some of the participants, we've pulled together some information about deal teams who should be involved with you to support you in getting a deal across the finish line, and then typical timelines that we see for getting a deal completed.
Here we have our first poll question here at the beginning of our presentation. Those of you who would like CP, please make sure you answer these polling questions, and I would love to have everyone else's feedback as well. First question is, when was your last business valuation completed? Give you about a minute here to go ahead and answer. And Mike, you want to present the results of this? Many of you have had one within the last 2 years, and then it's pretty evenly split between the rest of the answers. Thank you, everyone. Susan, we'll let you go ahead and continue.
Okay. Then I'm showing my screen again. Is that popping back up for everybody?
You currently have, you're not in the presenter view.
Okay, let me fix that. Did that do it?
Yep, it did.
Okay, thank you. Sorry about that. So this first slide here that we wanted to share is basically transaction activity in the industrial space from 2009 through to the third quarter of 2022. The third quarter of 2022 is the last period for when data is actually available. So that's as far as we were able to go with this chart. A couple of notes just on the mechanics of the data and how the data is put together. You'll see the numbers at the top of the bar charts. Those numbers represent EBITDA multiples for the average EBITDA multiples for the transactions that happened during that year in this sector. Just a cautionary note on the data. Clearly, we don't have EBITDA multiple information for all of the deals that closed during the relative time periods. Sometimes we get revenue multiple transaction data. Sometimes we get EBITDA transaction. Most of the time, there isn't multiple data reported. So this information really is more of a guide in terms of how the transactions are trending over the time period. It's not necessarily for purposes of you sort of saying, okay, 9.6 times my EBITDA, that's the valuation of my company. In any given year, there's probably like 15 to 20% of the deals where we'll have EBITDA multiple data available to us. So again, this is just for trending purposes that we're providing this information to you. We started with data in 2009, really because the last longer recession was from December of 2007 through to, it lasted 18 months. So it lasted through the midpoint almost of 2009. And then you can see on a relative basis, there were far fewer transactions and the EBITDA multiples were depressed relative to the rest of the time period here that we've got the data for. The other thing that's not apparent on the chart and maybe is something that people don't necessarily have active context around is at either end of the spectrum in this chart, we have interest rates moving in opposite directions. So starting in December of 2007, interest rates were at about the level that they are now, and they moved down so that by the end of the recession, interest rates were hovering at the level that they were last year when the Fed started raising interest rates. So just to give you sort of context around that, there's sort of a mirror image activity going in terms of the direction of where interest rates are moving. And really throughout this whole period, interest rates were relatively low throughout the period. So access to capital was readily available for the most part. A couple things to dig into in terms of the actual data. You know, while again, the 2009 data, the transaction levels and multiples were relatively low, you can see that in 2010 and 11, we really had a nice uptick in terms of return to volumes, and EBITDA multiples were on the rise again. Then I would say in the next 5 years or so, the volumes and multiples really return to sort of more of an average level than we see in 2017 to 19. Deal volumes were relatively in line with historic levels, but the multiples started to get a bit richer in this time period. And then of course we come to the 2020 period where we all know that there was a significant impact of COVID. I can speak from personal experience. We were very pleased that we were able to close the deal on March 8th of that year. And then from that point onward, in the year, probably until maybe the August timeframe, we didn't really have much activity in terms of new inbound calls for people that were considering selling their business, or for that matter, looking to make an acquisition. And clearly, I'm sure that the time period is fresh in people's mind, but companies were busy securing PPP money to get through the COVID impact, as well as making sure their employees were safe and dealing with supply chain issues, things of that nature. So certainly the 2020 numbers were depressed. I think if we were to split the 2020 stack up into quarters, what you'd find is that most of the deals that were closed in the first quarter and the beginning of the second quarter. Deals that were sort of underway or actively moving towards closure still did close, but again, the third quarter was very, very light, I'm sure, as was the fourth quarter. And then again, you see that the numbers increase again starting in 2021 through 2022. One of the things that I wanted to highlight on this chart is something that's actually not on the chart, which is the fourth quarter of 2022. Clearly we speak with bankers, we speak with private equity buyers all the time, and a couple of the things that started happening late in the second quarter or the fourth quarter of last year is that we, even in early November, I think it was, we had some banks say, we're done funding deals for the rest of the year. They were just sort of sitting on the sidelines, waiting to see what was happening. And similarly, some private equity buyers that were maybe making a minority stake in a company were ratcheting down the amount of capital that they were going to put toward that deal. So generally, as we're heading into 2023, people are feeling a sense of uncertainty, even though some of the metrics that are going on in the economy look positive. There's still a great deal of uncertainty as to whether there's going to be a protracted recession, or whether the recovery will be managed and will sort of have a soft landing, and it's impacting different players in different ways. So I just wanted to move on now to the next slide. This is really just providing some overall economic data. Again, you see the dramatic change in interest rates here. And then the growth rates really are just representing sort of the whiplash factor, I guess I would say, in terms of the COVID impact. This slide, again, just points to some data regarding, all of you, I'm presuming, have intensely lived through this, but this is just charting the unemployment rate versus US retail sales. And you can see there's a lot of volatility in here during the COVID era that's really just starting to even out a little bit in the last year or so. One of the things to point to that I would say started in 2020, certainly with the COVID impact, is that what we saw in terms of deal structure is that a lot of the buyers were looking to inject an element of structure into the deal terms. And what I mean by that is they were really asking companies to accept offers that included an earnout. And the reason for that is really by what's illustrated on this chart. Whether companies experienced a negative impact from COVID or a positive impact from COVID, the buyers of any of the companies wanted to make sure whatever performance a company was demonstrating, that those performances would be sustainable. And so the way that a buyer can protect themselves from that risk is to inject an element of earnout into the offer for the business, so that essentially, if the performance doesn't continue, the buyer's protected against that potential outcome. So now I want to delve into some of the factors that impact M&A multiples. Some of these items are really externalities, and some of them are things that a company would have more control over. So first, interest rates. I've mentioned interest rates a fair bit here, but to delve into this, I mean, the real reason why interest rates have a significant impact on M&A is that private equity buyers in particular almost always layer on debt on a transaction. So as interest rates are rising, the availability of capital, the calculus that they're using to get their projected returns, all of that changes. And so really what we see is more private equity buyers sort of either staying on the sidelines, or maybe they're more focused on add-on opportunities as opposed to more platform investments that they might normally make. So this really just makes it such that the overall market is perhaps less active and therefore less competitive. And so in times past, you might have had multiple offers with a number of private equity companies coming into the mix, whereas now with interest rates lower, deals that are perhaps are a little bit riskier that may have gotten done in other times either may not get done, or they might just get done at a lower multiple level. Another factor is just, again, as we've discussed, some economic uncertainty. Uncertainty always impacts the M&A market. People just tend to get more conservative. We'll have, again, private equity companies might be more focused on their portfolio companies that they already have, making sure that they are, well cared for, and they have the capital that they'll need to continue to perform well. Whereas, before they might have been focused more on additional business development activities. And again, this, less participation in the market just means things are less competitive. There's fewer, a seller would have less leverage if they've got fewer buyers that are in the mix and considering their company. So those are just factors to consider. One point that I guess I want to make around the economic uncertainty factor is, to the extent that you are more on the buy side of a transaction, economic uncertainty in general may play well to you if you happen to be in the sector or you happen to be performing well and you have a healthy balance sheet. If the market overall is less competitive, it may present opportunities for you to grow through acquisition. Again, assuming that your business is healthy and on track in this market, it may present an opportunity where some of your competitors or adjacent space companies might not be as healthy, and you may be able to take advantage of that. On the COVID normalization factor, the point that I wanted to mention here is, typically as buyers look to make an acquisition, the way that they analyze the situation is they'll take the last 3 years performance data, and then they'll also ask for a forecast for the year ahead. So clearly any transaction that would be taking place in the current time frame would be looking at data from 2020 through to 2022 data plus the forecast for this year. And so to the extent that a company was, let's say as an example, a company had a negative impact for 2020, but then their 21 data and 22 data sort of returned to the pre-COVID levels and is, continuing to grow on a nice trajectory. The further that, we'll call it a COVID blip perhaps, gets into the rearview mirror, the farther away it is, the more confidence a buyer would have that the trend that they're seeing is something that is more a normal trend and something that's sustainable. Again, we work with clients, that are in the manufacturing space, and perhaps their sector was one that benefited from COVID, the same factor comes into play. People want to make sure, buyers want to make sure that whatever that performance is going to be normalized. Another note, just as we talked about multiples here, let's say a company's profile looks more to the, the first 2 years were depressed, and then the third year was really high growth. A buyer is not going to just take that last year's growth and apply a multiple to that. They'll probably average out those 3 years and then look to apply the multiple to it. So now I'm going to shift into these last few factors here that really deal with areas that are more within the control of an owner. So the first one is customer or supplier concentration. This is something, again, where the buyer is really looking to really mitigate risks as they look at an opportunity. And if they see a situation where a customer represents, say, 30% of a top line of a company, or that there's significant supplier concentration, say one supplier is responsible for a disproportionate amount of a company's revenues, that is a situation that's uncomfortable for a buyer. Those types of things are considered to be, or sometimes characterized as stroke of the pen risk. So if a single customer or supplier has an ability to dramatically impact performance, that's the type of thing where a buyer is really going to be cautious, and that may either depress the multiple that they're willing to pay, or another way that buyers sometimes mitigate that risk is that they will do an earnout of some kind to make sure that those customers remain active post the transaction, or that supplier, again, remains an important factor in the overall growth of it. Again, one of the things that I'll point to sort of on the flip side with this customer concentration issue, if you happen to be on the buy side and you're looking to acquire a company that's in the same space that you're in, it may not be as much of a concern for you if a target has customer concentration, because either you feel comfortable that you can redeploy the assets in that business to some other customers, or in the big picture of things, if a target is only going to represent, say, 25 or 30% of the overall business of the new entity, then their customer concentration may not be such an issue for you. So again, if you're on the buy side, it may be an opportunity for you to expand that way and not really have to be that worried about customer concentration. Another factor that buyers take into account as they are considering the multiple that they're willing to pay is, again, they're just looking for consistency of performance, growth, and the margin profile of a target. There are particularly financial buyers that will not sometimes look at a company if it doesn't meet a minimum margin threshold. So that's a factor in, again, how competitive the set of buyers is for your particular company. Buyers are typically looking for, nice consistent performance in a perfect world, with growth, but also prospects for growth. Particularly if it's a financial buyer, what they're trying to understand is if a company had access to additional capital, how could or would they grow the business even further? So those are all aspects of the profile of the company that's important to get across to people as you're going out to the market to potentially sell the company. Excuse me. I'm going to skip to the last bullet point first and then pop back to size, because I've got some data to show on the following slide. There's other risk factors. This is a little bit of a catch-all in terms of this bullet point, but if you're in a situation where, say, the next layer of management after the owners are planning on retiring in 6 to 12 months, or if you have, some situation that's going on within your company, hopefully this is not the case, but say there's some litigation that's going on or something like that, the overall guidance would be to get your house in order before you would take a company out for sale. Any of those types of factors, like, a substantial amount of the leadership team going away, or, some sort of litigation that is not settled, is not dealt with already, those types of things would impact the multiple, or even potentially the interest that a company might have in terms of making an offer for a business. The size of the business is the next one I want to come to. I've got a chart here that just illustrates a little bit of deal size premiums. So just a note on how we developed the data for this. We basically took the median multiples that were paid for deals that had EBITDA of $10 to $20 million, and we compared those to deals where the EBITDA was $1 to $5 million. And as you can see here, there's a significant difference in the multiple that was paid for those businesses. So if you recall from the prior page, the 2017 through 2019 era, multiples were sort of in the above the 10x range for the average across all deals that were disclosed. But here what we're seeing is that, if a company were smaller, only had $1 or $2 million of EBITDA, that transaction would have received a multiple that was significantly less, up to 3 turns in the 2019 era. Again, not unexpectedly, 2020, the numbers came down a little bit just because I think there were fewer deals that were being done. But again, the size premium increased again starting in 2021 to 2022. Some of the things that are, to bear in mind here is this is just taking size as a characteristic. There's always, as mentioned on the previous slide, there's always additional factors that come into play in terms of, the growth trajectory and customer concentration, those types of things. We obviously couldn't control for those things in presenting this data, but at least wanted to make it clear to everyone that, as you're considering selling your company, it would be really in your best interest if you could get a valuation done on your business that is really specific to the unique aspects of your business, as opposed to just taking deal multiples in the aggregate, since it's really important to get what's characterized as an apples to apples evaluation done on your company. And now I think we're coming up to another polling question.
Thank you, Susan. Our next polling question is, I may begin exploring the sale of my business within. And you have a choice of how soon you might be exploring a sale. So those who need CPE, please make sure that you complete the polling question. Certainly interested in what others have to say as well. I'll give you a minute to go ahead and answer the question. Okay, Michael, let's go ahead and see the data. Interesting. Pretty evenly spread between 12 months and 5 years, but near about half not interested. Very interesting. Thank you. We'll go ahead and move on.
Okay, for the next few slides here, I'm just going to talk about some things that are more tied to the mechanics of transactions, really. So In a perfect world, I'm sure all of you would love to receive a 100% cash offer for 100% of the stock of your business if you were in a selling mode. But those types of deals are relatively unusual. First of all, most opportunities presented will be for the assets of the business, just because buyers frequently do not want to assume the liabilities of a company if they were to make a stock purchase. The other factor in terms of financing options are earnouts. You can really think of an earnout as being a means for a buyer to finance an opportunity, because essentially, while they are potentially developing that structure so that their risk is mitigated, they're really paying you out of the proceeds of the company that they now own. So they're able to use the earnings of the company basically to pay you for your own company. Bank debt is clearly frequently used by private equity companies as well. It's very frequently used by private equity companies, but if we're advising a client that is a strategic and looking to make an acquisition, we also recommend that they leverage bank debt as well in terms of how they structure the deal. One note on this, just in terms of considering offers that may come in, all things being equal, let's say you have 2 offers for your business. Typically what we will ask when we're requesting letters of intent to buy a company is that they put any contingencies on their offer. So sometimes it's subject to board approval, sometimes it's subject to financing. If you do have 2 otherwise equal opportunities and one has financing risk, the other one doesn't, you want to clearly think through that and make sure that you're willing to accept that contingent financing risk and delve into that a little bit, because should the financing not materialize, you've clearly lost several weeks and probably months in terms of having to then cycle back to other buyers that may have been interested earlier on that have stepped away from the deal, or if you didn't accept their offer, they've moved on potentially. The last type of financing I just wanted to highlight briefly here is seller financing. This sometimes comes into play in more challenging markets, but one thing that may be included in your offer, let's say you've received an offer for $10 million for your business, a buyer may ask that you finance part of the deal. So they will give you a seller note for, say, perhaps $2 million or something like that, and pay you market interest rates for a period of a few years, hopefully a limited period of years, but maybe 2 or 3 years, they might offer you something like that. In terms of the buyer outlook, again, I mentioned that we continue to receive calls all the time from financial buyers, from private equity buyers, and then again, strategic buyers, as long as they've got a healthy balance sheet, they're still looking for opportunities. What we're hearing more broadly is that, and what we're seeing as well, is that private equity buyers are tending to skew more towards looking for add-ons to existing portfolio companies in this market. And what we've heard from private equity buyers is that in their processes that they're participating in, it seems to be a bit more balanced, with more strategic buyers entering the mix and than in historic times, as opposed to sometimes processes have been more overwhelmed with private equity buyers. The deal team. So again, before we started this presentation, people asked us, who are the key members of the deal team that I need to pull together for this? So, reading across the page, the key members of the team would be an investment banker. That might be a little self-serving, but I'll share some thoughts about why we think it's important to engage an investment banker in the process. You'll need a transaction attorney, and I want to emphasize that it's really important for the lawyer to have M&A experience. Then the other advisors that are important to this prospect are CPA and tax advisors. So in terms of the investment banker, really the investment banker helps make processes more competitive and more efficient. So I think, you know, just the mere fact that you've got an investment banker involved in the process signals that the parties are serious about getting something done. And in terms of, you know, improving the competitiveness, we've even had situations where a client might reach out to us and say they've received an unsolicited offer. And even in those situations where perhaps we don't even open up the process to additional buyers, we do find that we are able to improve the offer substantially in those situations, and clearly well beyond the cost that's involved with engaging an investment banker and something like that. For the transaction lawyer, clearly, again, you want someone that really is experienced in M&A so that they know what is market and what's typical. The whole aspect of a transaction attorney guiding you through this process, once you get the purchase agreement, that contract between both parties is really designed to balance risks to both parties. And, you know, we really want a transaction attorney that understands what is market. This may be, you know, the only time that you go through a process like this. So it's important to use, you know, a transaction lawyer that you've been referred to, hopefully from another trusted advisor like your CPA firm or the investment banker that you might be working with, because they can definitely make the process more difficult, and you certainly want to be assured that you're protected in this. In terms of your CPA or tax advisors, there's a couple different ways that these professionals come into play. If you've got multiple offers, for instance, and they're significantly different structures, you know, one may have certain tax advantages relative to the other structure, and you'll want to understand that with your tax advisor. Your CPA can obviously help us with diligence that would go on during a transaction. But in addition to that, I just wanted to mention the idea of equality of earnings. If you are considering selling your company, it's advisable to have equality of earnings done. This helps highlight any financial idiosyncrasies or issues that your business may be experiencing, and it gives you a couple different pathways. One, you could potentially mitigate some of those issues, or if it's not possible for you to address those issues before taking the company out to sale, at least we can be transparent early on in the process so that a buyer understands the parameters around your business. Because the worst thing that can happen typically in an engagement, once you have an LOI, the financial diligence is the first thing that takes place. And, you know, if you run into an issue, if there's a hiccup along the way because of something that they've discovered in the financial diligence, you know, that's certainly going to be problematic. It might even, you know, end the deal, and you'd have to start over with the process. And again, you will have lost a lot of time and effort in getting something completed. So we have our last polling question now to move on to.
Thank you, Susan. Our next question is, what is the biggest challenge or concern with running your company? Give you a moment to answer the questions. Go ahead and close the poll. Gather the results. Yeah. Not surprising, the economic uncertainty garnering the most votes. Still continue with the supply chain disruptions. as well. Thank you, everyone. Go ahead, Susan.
Okay. So now I wanted to share our thoughts about the typical time frame that it will take to get a process completed from beginning to end. The first step in the process is overall preparation. So if this is a sell side, really what we're doing is working with a company to understand a company as best as possible. We'll prepare a one-page cloaked information document that we'll share with a broad range of buyers. We'll work with the seller to make sure that the buyer's list is something that they approve of. And, you know, we've had clients that have come up to us and said, you know, there's these 5 strategics that I don't want you to go and approach at all because I don't want them to know that we have a process going on, or I know the culture within that company and I don't want, you know, my company to be part of that entity because I just know it would not be a fit. But in general, we're preparing all the information to market the company. So there's a one-pager. And then after a company, after we've gone out to the market, we would ask interested parties to go under a non-disclosure agreement and then send them a longer document that's probably 30, 40, 50 pages, depending on the business, that describes the company in more detail. I will just share an anecdote. We've had companies tell us that, you know, the one pager doesn't really describe them very well, and that's sort of the point. Early on in the process, we're just trying to understand if a prospective buyer is interested in engaging in the sector with a company with, you know, that sort of financial profile, really. And then the longer document is designed to share more information with them so that they can get specific and potentially present an offer to the company. So in the preparation side, I'll just briefly touch on buy sides. In a buy side situation, we're working with clients to understand what their goals are, what they're trying to achieve, if they're looking for geographic expansion, if they're looking to enter certain adjacencies, if they're looking to acquire different capabilities or something, you know, then we obviously will look or we'll leverage a list that they may have of targets that they want to go after, but then we're also doing research to find additional targets to broaden the scope of this. Then the next phase, initiating the process. Again, this is what it sounds like. It's us reaching out to prospective buyers, or in the case of a buy side, reaching out to prospective targets. Then in the selecting the buyer section, if it's a sell side, we will have requested indications of interest. Then there'd be likely site visits or management presentations during this phase of it. And then we're asking those parties that were interested to sort of sharpen their pencils and give us, you know, a more defined offer, and again, with any contingencies around what they would need to close the transaction. The executing the transaction phase, it's typically minimally 90 days. During that period, what we're primarily doing is going through a deeper diligence level earlier on in the process, before we get letters of interest. They will have done some diligence. You know, that we typically would have people ask a few more questions, but in this executing the transaction phase, they're doing exhaustive diligence, HR diligence, insurance. They're trying to understand basically every aspect of how your company runs so that they can transition it to the post-transaction category. And then the most significant activity that's happening here in the executing the transaction is reviewing the purchase agreement. This is where your lawyer will get involved more deeply. Clearly, you know, your investment banker and your accountant aren't allowed to advise you on legal matters. So this is where your M&A transaction attorney is really getting involved with the situation and helping to protect you and make sure that all the risks are managed and understood throughout the process. So In total, and again, these are really ranges. They can take longer. They can sometimes take shorter. Executing the transaction really doesn't happen much quicker than that ever, again, because there's a lot of things that are happening that just, take some time in there. There'll also be, if you're planning to stay on and work for a transitionary period, there'll be employment agreements that are negotiated there. If you happen to own the buildings that you have, there'll be lease agreements that'll come in with that as well. Things that can change the process somewhat on the preparation side. If you don't have the materials readily available for us to work with you to create the marketing materials, that part can take a little bit longer. In the initiating the process section, if your opportunity is more skewed towards strategic buyers, sometimes we slow the process down during this phase to enable more strategic buyers to participate. Financial buyers, if you think about it, this is what they do for a living, so they tend to be fairly efficient. Strategic buyers don't make as many acquisitions typically, so engaging all the right people on their part or dispensing with other priorities potentially, that may take up some time in the process. So really, that can get blown out if there is a specific strategic that you particularly want to engage in this process. But overall, there'd be a minimum of sort of 7 months to go from start to finish. But the process can take longer depending on dynamics that go on during the process. One just last note that I'd make in terms of the buy side, there's a reason why we made this a sell side timeline chart. The buy side is a little bit more difficult to predict. I mean, really, in the initiating the process section, by definition, we're sort of going through a process and approaching people that are not for sale already. So that process of getting them to consider a sale and sort of envisioning what their life might look like if they were part of the acquiring entity can sometimes take some time. Just circling back to the investment banker's role in this, with buy-side transactions, we frequently find that, sort of coaching the target through the possible process and how it would work and how the two companies would come together ends up being a big part of this. And so again, it's kind of iterative with a buy side, but it's also sort of wooing the target and getting them excited about potentially being acquired. The time that takes is a little bit difficult to assess sometimes. Also, these processes, particularly if you're going after a competitive, the process can be a very delicate dance in terms of the disclosure that you're comfortable with, that a target might be comfortable with. They want to sort of gauge real interest and sort of make sure there's a chemistry or a strategic fit, but they're also cautious about how much information they would disclose to a competitor sort of right off the bat. So that really concludes the presentation here, and we are happy to entertain any questions that all of you may have.